Hey, welcome to another episode of Make Money Count. Today is a special episode because we're going to talk about the monetary policy report that was just issued by the Bank of Canada. We had some real goodies in the report. I want to walk you through them. Coles notes the Bank of Canada has paused interest rate hikes. The overnight rate is 5%. The prime rate will continue to be 7.2%. We will show you what the reasoning behind that is, how it affected the CDOR market. Remember that fund market on the TMX that tells us the probability of future rate hikes or drops? And then we'll see what Jamie Dimon has to say about central bankers. In the meantime, your job is to hit subscribe and leave comments and like this video. Let's get started. The monetary policy report just got issued today. Bank of Canada met. So the monetary policy report had all kinds of goodies in it. To start off, I want to highlight that the growth rate that the Bank of Canada projects for our country has dropped. So the Bank of Canada now expects the Canadian economy to grow by 1.2% this year, 0.9% in 2024, and 2.5% in 2025. I find the more and more I keep reading these monetary policy reports and the issuances from the Federal Reserve in the United States, they always seem to want to push out the growth further and further. And if you look back, the growth really never materializes. So I wouldn't hang our hats on that 2.5% in 2025. The reason why I highlighted this is it really feels as though the Bank of Canada is gradually and continually cutting back their growth forecasts for the Canadian economy. We went through this report and there are a couple points that I find really interesting. Number one, for sure, Canada's not growing as fast as the Bank of Canada expected it to grow, and that's creating a problem. Things that the Bank of Canada are seeing as contributing to inflation, and they mention it a couple times. One of them is corporate pricing behavior. Tiff Macklin actually specifically spoke to it. Corporations are far more quick to transfer expenses of input prices. Whenever a corporation sees that their input prices are increasing right now, they're transferring it right to the consumer immediately. So it's very, very quick to see price increases. And that's why we're seeing these food prices increase month over month, year over year, because immediately, whenever an input price increases, it's getting transferred over to the end consumer. Now, the big fear, in addition to this kind of corporate behavior, is how oil is going to trickle in through the economy. And we always kind of extract oil from our CPI numbers. It's important to understand how the Bank of Canada is thinking about it, coupled with the way they view corporate behavior and their ability to immediately transfer these input costs. Is the Bank of Canada has kind of underestimated oil prices, and they mention that in the monetary policy report. And they're saying that they underestimated the increases in oil prices, and their concern is if the oil price increases then start seeping in as an input cost to corporations that are selling us things, then that could see those prices start to creep up and stay there. And that is systemic, right? Like that is longer term inflationary, just like wages, right? Think about wages as just another input similar to oil. All of these negotiations that are going on with unions right now could lead to a higher input price of wages. And then knowing that corporate behavior is more easy to pass those input costs on to the consumer, we know that it's going to affect inflation. So that's what the Bank of Canada is worried about. The biggest problem is, regardless, we have consumer sentiment and consumer spending dropping. In the face of consumer spending and consumer sentiment dropping to the extent that it is, retail sales coming down, corporate behavior is going to change too, right? Corporations won't be as easy to hand over these input pressures. They may push back on some of these input pressures instead. And that's how we start seeing inflation numbers come down. Very important to note. The Bank of Canada uses a whole bunch of data to make decisions, and the decision that they just made is that they're going to leave interest rates where they are. Few other cool tidbits of information. Tiff Macklin said that even if we haven't hit our 2% target, if we feel as though we are on our way, we're going to drop rates. We know that their prediction is that we're not going to hit the 2% target till 2025. As soon as this happened, the probabilities, that CDOR market that we've been tracking, were affected. What we saw right away was the probability of that rate drop happening June of 2024 went up. We can see The December likelihood of a hike is 12%. And I think you can expect to see that drop. And then the likelihood that we are exactly where we are right now in March of 2024 is 100%. Then you can see the June of 2024, 50% probability that we're going to be down 25 basis points. I can guarantee you that these numbers, these probabilities are going to get higher. The probability that we are 25 basis points lower in June of 2024 will not be 50% as we get closer and closer to June of 2024. The Bank of Canada is seeing weakness in the economy. These consumer sentiment and consumer spending numbers that we talk about in depth are going to really start, and they already are starting to affect the Bank of Canada's decision. The reason why there was a bit of a hawkish tone in the Bank of Canada Monetary Policy Report and in the subsequent question and answer period is that they do not want to see these probabilities go to 100% rate drop by June of 2024, because again, we spoke about that, right? It's a little bit of this monetary policy speak. So they speak hawkishly so that they can avoid having to possibly increase rates or leave rates higher for any longer than they absolutely must. Good news, in my opinion, out of the Monetary Policy Report, in that we're not going to see increases in interest rates. Bad news in that the economy is softening more than the Bank of Canada expected. There was also another little line in there that Tiff Macklin says the likelihood of a soft landing is narrowing, or the runway for a soft landing is narrowing. I forget the exact wording that he used. And I think that it gives you a bit of a wink or a nod to what they are thinking right now. Consumer spending and the consumer sentiment has fallen off a cliff. Canadians are worried. The cost of debt has skyrocketed. It is eating into all spending, all sentiment numbers. It is only getting worse. One last thing that I want to point out is that you can see now that March of 2024 is now a 50% chance, a little over 50% chance that rates are 1.5 percentage points lower. The market is convinced rates are going down. So if you're forced to negotiate a mortgage renewal right now, you got to be thinking variable. You need to look at these numbers. You do not want to be stuck in a 5-year fixed rate mortgage when interest rates are literally just dropping off a cliff. I know that this higher for longer that everyone's been talking about is seeped in to the psyche of the borrower, but higher for longer may actually just mean high rates from what we're used to, and longer is predicated on the idea that we have a soft landing. Longer, higher for longer rates means that like the Bank of Canada knocked it out of the park and they did such a great job. There is nothing to lead us to believe that the Bank of Canada or the Federal Reserve is going to knock it out of the park, right? We like to cite David Mackay, the CEO of Royal Bank, right? Largest bank in Canada, who said back in August that June of 2024 is when rates are going to turn. Rates are going to come down then. And I said at the time, he is not predicting what the market is going to do. He is telling the market what it needs to do. And you're seeing it now, right? This is going to come to fruition. Well, what does Jamie Dimon have to say? Jamie Dimon says that central bankers are always wrong. Their forecasts are never right. And he has a real concern about what is happening in the United States right now. Everybody should give this a bit of a read. In his opinion, whether or not the Federal Reserve increases by another 25 basis points doesn't make a difference. And you know what? It wouldn't have made a difference here in Canada either. The Canadian consumer is stretched. The Canadian consumer has been toasted. Another 25 basis points, not going to make a difference. What will make a difference is when we're finally on a path to reducing interest rates and normalizing them. The inflation numbers are going to be a little bit sticky, and they're going to be a little bit sticky because of factors that are outside of our control, right? Canadians can't impact the price of input oil, unfortunately. We should be able to some extent, because we have so much domestic oil available to us, but we can't impact. And Canadians are unable to affect interest rates right now, and that is a massive contributor to shelter costs. The good news is interest rates are not going to be higher for longer, okay? They're going to start coming off, maybe even sooner than June of 2024. We'll see. I think if this report leads us to believe anything, it's that rates are going to come down faster than we thought. We'd be interested to hear what you think is going to happen with interest rates. I bet 25 basis points lower for sure by June of 2024. What do you think? Remember to like, comment, and subscribe. And thank you so much for continuing to visit and enjoying our content.